Welcome to The Explainer. I'm so thrilled you're joining me today because honestly, we have a truly fascinating dual narrative to unpack. On one hand, we're looking at this massive, unprecedented global artificial intelligence boom that is quite literally rewriting economic forecasts as we speak. But on the other hand, we have to look at the incredibly complex, heavily layered geopolitical landscape that this economic rocket ship has to navigate. It's this incredible story of rapid technological acceleration running absolutely headfirst into global uncertainty.
Okay, let's dive into this. 88.1%. Let that sink in for a second. That is not an annual figure, and it is certainly not a decade-long growth stat. That's just one single quarter. That staggering number represents the second quarter surge in Singapore's electronics sector alone. It's a massive, record-breaking leap, and it's being entirely driven by the ferocious global demand for AI infrastructure.
To make sense of all this crazy data, here's our roadmap for today. We'll start by mapping out the global AI gold rush. Then we'll zoom in on Singapore's massive economic upgrade. Next, we'll look at a tale of two economies, scan the global risk radar, and finally ask, will the momentum last?
Starting with Section 1, the global AI gold rush, and how digital trends manifest in physical infrastructure. When we hear the term artificial intelligence, it's super easy to picture it as something invisible, right? Like some software or algorithm just floating around in the cloud. But economically speaking, the AI investment boom is intensely physical. It's defined by a rapid acceleration in global capital expenditure that specifically targets machines, computing equipment, huge data centers, and all the logistics required to move them around. And this physical infrastructure demand has proven to be way more resilient than a lot of analysts initially predicted earlier this year.
So what this means is that the highly abstract world of AI is literally supercharging the global economy through hard goods. The global appetite for semiconductors, integrated circuits, disk media, and precision engineering components is just completely off the charts right now. Nations that manufacture and trade these specific pieces of hardware, well, they're rapidly turning into the absolute primary hubs for tomorrow's tech infrastructure.
Let's move to and see how this builds into Section 2, Singapore's massive economic upgrade, translating tech demand into GDP growth.
This relentless global demand is having a direct, profound impact right on the ground. Thanks to this AI boom, Singapore's Ministry of Trade and Industry just radically upgraded its 2026 GDP growth forecast. They bumped it all the way up to a range of 4.5 to 5.5%. When you were talking about an entire nation's GDP, essentially doubling your initial projection is a historic jump. And this upgrade comes right on the heels of the economy already expanding 6.1% year-on-year in the first half of the year. That marks their strongest first-half performance in years.
Now, if we break that growth down by sector, it really shows us the underlying mechanics of this boom. There's that 88.1% second quarter surge in electronics we talked about, totally driven by semiconductor and AI hardware demand. And that, in turn, fueled an 18.6% rise in non-oil domestic exports in the first half. To put that in perspective, that's the strongest performance for that sector since 2010. Naturally, the wealth generated from all this frenetic activity is accelerating the financial services sector, which is seeing really strong credit growth and huge wealth inflows. The momentum is even spilling over into wholesale trade and logistics as supply chains ramp up to meet the moment.
Moving on to Section 3, a tale of two economies, examining the disconnect between macro data and daily reality.
Now, what's really interesting about this slide is the stark contrast it illustrates. A 6.1% economic expansion sounds universally fantastic across the board, right? But the reality on the ground is that it's not being felt equally. We essentially have two totally different economies running in parallel right now. Over on the left side, the external-facing economy is booming with tech exports, huge capital investment, and thriving wholesale trade. But look at the right side. The domestic economy is facing subdued household consumption, tight consumer budgets, and a food and beverage sector that actually contracted in the second quarter.
So the crucial takeaway here is that while the tech and trade sectors are flying incredibly high, everyday consumers are feeling a real tangible squeeze. If you've looked at your own grocery or utility bills lately, you probably know exactly what this means. People are having to navigate rising food costs, higher fuel prices, increased water tariffs, and broad inflationary pressure. And yes, while government support measures like CDC vouchers are definitely helping to cushion the impact, consumer spending remains incredibly cautious overall.
Sean Yu, a senior economist at Oxford Economics, sums this up perfectly. He points out that this current expansion is really a story of stronger trade and investment, rather than the domestic economy. The hard reality is that the immense wealth being generated by the AI investment boom is going to take a significant amount of time to actually propagate down to small and medium enterprises and everyday workers.
Which brings us to Section 4, the Global Risk Radar. These are the geopolitical uncertainties tracking right in the background. So, while this tech hardware boom is driving markets upward, we have to remember that international trade does not exist in a vacuum. We are currently navigating a highly complex geopolitical timeline. Unresolved legal and diplomatic issues from the past year or so are suddenly culminating right now in August 2026, creating some very real potential headwinds for global markets. Let's look at the specifics.
First up, in the U.S., a federal judge in Brooklyn has officially dismissed fraud and bribery charges against Indian billionaire Gautam Adani and his nephew after the Justice Department moved to abandon the case. Now, these charges, which were filed back in late 2024, had alleged a $250 million bribery scheme. The presiding judge, Nicholas Garufis, granted the dismissal, but he also openly criticized prosecutors for working with the defense without getting input from the investigating agents. He did, however, explicitly confirm that Adani's prior pledge to invest $10 billion in the U.S. did not factor into the dismissal at all. But make no mistake, the impact of billions of dollars in international investments hanging in the balance of these court decisions is a major variable for global markets.
Over on the diplomatic front, efforts to finalize the Iran peace deal have hit a hurdle. Iran has formally rejected U.S. demands for compensation regarding damage incurred during the conflict. Iran stated that this new proposal is inconsistent with the terms of the preliminary peace deal that was signed back in June. This rejection complicates the framework to reopen the Strait of Hormuz, which is currently being negotiated with Oman, and that keeps global energy and shipping supply uncertainty elevated. In fact, it's already pushed Brent crude oil above $87.81 a barrel. And why does this matter for tech? Well, elevated crude oil prices mean higher shipping costs for all that heavy, physical AI infrastructure we were just talking about.
Finally, looking regionally, the Philippines House of Representatives overwhelmingly passed a Digital Media Anti-False Information Act, commonly known as the Disinformation Bill, with a vote of 286-3. The legislation now heads to the Senate. This passage has drawn immediate responses from journalists and researchers who actively document disinformation. They are urging lawmakers to reject the measure, citing significant concerns over its potential impact on press freedom.
And that leads us perfectly into Section 5. Will the momentum last? Let's project the future of the global AI cycle.
And this brilliantly illustrates exactly where this is all heading. Despite those simmering geopolitical risks we just outlined, the economic forecast for AI remains structural and massive. Oxford Economics actually projects that by the end of this decade, AI-related goods will rise from their current level of around 20% to just under 22% of total world trade. Think about that for a second. That is an absolutely enormous slice of the entire global economic pie dedicated purely to AI infrastructure.
But, as we know, no cycle lasts forever in its initial form. Here's the projected timeline for how this tech evolution plays out. Step 1, strong AI capital expenditure continues to drive the 2020s. Step 2, this initial AI infrastructure cycle is expected to finally begin leveling off around 2029. But Step 3 is where it gets incredibly exciting. Analysts project that the next massive multi-year growth phase will actually shift toward mass-market robotics for both consumers and enterprises. Knowing this shift is coming, economies like Singapore are already working to diversify their investments into robotics, pharmaceuticals, and chemicals so they avoid being overly reliant on just one phase of the AI boom.
Which leaves us with this final, crucial thought for today's explainer. As this unprecedented AI boom really hits its stride, entirely reshaping global trade and domestic GDPs, will those simmering geopolitical tensions in the background eventually derail the global economy? Or is this technological revolution simply unstoppable at this point? It's a fascinating tension to watch, and one that is absolutely going to define the rest of this decade. Thank you so much for exploring this with me today. Keep learning, and I'll catch you on the next one.